یه چند دقیقه راجع به کلیات قضیه صحبت میکنم. بعد آقای فتح‌الله زاده یه پرزنتیشن دارن، بعد آقای عبهری و آقای توانا و آقای فتح‌الله زاده سوالاتی که در ارتباط با این مسئله طرح جدید تکس هستش رو جواب میدن و هدف نهایی هم این است که ما سامری این جلسه رو و کیسایی رو که به عنوان نمونه مطرح میشه رو منتقل میکنیم به دفتر آقای جوهری و دفتر آقای علی احساسی که در اتاوا در کمیسیونایی که خواهد بودش مطرح بکنم برای اپینین پابلیک. من خواهش کنم آقای توانا تشریف بیارن.
این پرزنتیشن رو من به انگلیسی تهیه کرده بودم، یعنی صحبتمو ولی مثل اینکه به فارسی هم میشه فعلا
به قول معروف خارجی ها پیداشون نشده.
دولت فدرال یه پروپوزالی دادش به یه نامه آقای
Tavana, I think you have to go to English.
Okay, that's good. Makes it easier for me. So we're talking about a proposal that was presented by the federal government regarding the changes to the Income Tax Act, which is a proposal, and it's open for discussion until Monday. And then the government would decide how to proceed. I'm going to read you a couple of paragraphs from Mr. Murnau's letter. And after discussing about the economic advantages of the previous legislations and the economic growth and the brilliant performance of the Canadian economy, he gets to this paragraph. He says, when the rules are used for personal benefits, they're not contributing to growing our economy. Rather, such practices can undermine confidence in our economy by giving tax advantages to a select few. We don't think that's fair. The select few would be literally all small businesses that incorporate, including professionals. And that's not what he said. Our government is proposing solutions to close loopholes and deal with tax planning strategies that involve the use of private corporations. Private corporations, not public corporations. So public corporations are immune. The telecoms, the oil companies, the banks, they don't get touched. That's why over the next 75 days, we're asking for your help in telling us where we have it right and where we can make improvements. Well, if you've been watching television, you have seen or read in media what kind of resistances the public put forward against these proposals. I believe yesterday Mr. Murnau had a meeting in Oakville, and some people may have watched that on television. A lot of questions were asked, and Mr. Appery is actually pointing out to an interesting question, which I think he's going to probably explain how it was answered. That's the spirit in which we are making these proposals, and the spirit with which we hope to receive comments. Of the spirit is our intention. Our intention, it bears repeating, is to help businesses grow, create jobs, and support their communities. I can't understand how businesses can grow if they're taxed. Small businesses can grow if they're taxed heavier. So I would translate these comments to basically that the whole economy would have to shrink, while a small group of, while the small businesses would even suffer greater. And that's like the English adage that says, cutting one's nose to spite one's face. Well, thank God that these measures are proposals, and they are going to be commented upon. Mr. Fatullah Zari is going to give a more detailed presentation on the proposals, and questions can be asked afterwards in Farsi, in English, and the panel would be happy to answer them. These measures are directed to the Canadian Controlled Private Corporations, CCPCs. And as I mentioned, they are not directed to the larger public companies. The CCPCs include the small businesses, the IT consultants, small manufacturing businesses, hospitality businesses, as well as professionals. Probably the main focus was the professionals, but everybody else was lumped together in these measures. I'm going to touch on one of the issues that has some significance, and that is to do with the small business corporation tax. Small business corporations enjoy a tax of 15% on their first $500,000 of taxable income. That is a benefit. And obviously, when it was enacted, there was a reason behind it. There was an economic reason. I guess the government at the time thought that small business is the backbone of the economy. It's the sector that brings about most employment, and it needs to be helped with a little bit of taxation. Now, what seems to be the problem is the 85% that stays in the company, and some of that is paid out as for living expenses of the business owner, but the other part is left in the company. And I don't think Mr. Morneau is against that part being invested in the company itself. As long as it's in the active business, that retained earning is fine. But once it becomes passive, and passive meaning it's not invested in that business, but it means that if that extra fund is somehow invested in a similar business, it becomes a loan, and that becomes passive investment. So investment in another business directly by a small business corporation is considered passive, and once that becomes passive, there is a tax on it. Until that extra money is paid out as a dividend, and the government gets its fair share of tax. So basically what the government is saying is to invest your extra funds in the small business corporation in other businesses directly, or through the stock market, because that gets invested in the economy, or through the banks, and every dollar that goes in the bank somehow gets paid out as a loan or investment in other businesses. So that is not something that this proposal wishes to continue by taxing the retained earning, the retained passive income. So the government wants that to be paid out. They want to incentivize the payment of this as a dividend. Therefore, the owner would have to pay an extra 45% tax if it's in the top tax bracket, and the government will be taking care of that money instead of the private sector. Now, if you believe the government to be a good business person and can use those funds more efficiently in the economy, then maybe the proposal is correct. But I think most economists agree that the government is not as good a business person as entrepreneurs and other businesses. Just to finish my short presentation, I wanted to mention a country in Europe that we came across its taxation system. It's one of the fastest growing economies in Europe, and it has the cleanest air, beautiful environment, and that country is Estonia. It's one of the Baltic states in Northern Europe. We found out that Estonia has no corporate tax. The corporate tax in Estonia is 0. The only time a corporation pays tax, it's when it pays out its profits as dividends, and it goes in the pocket of the owners. Of course, like Canada, Estonia is very strict on monies being allocated for the benefit of the shareholder, like a company car or, any expenditure that could resemble benefiting the shareholders is taxed as dividend. The corporation pays tax, fine, so does the individual. So the philosophy is as long as the money is in the corporation, it's working for the economy, either directly or through investment through other mediums in other entities, other companies, other organizations. I personally believe that corporation tax is actually income tax is not as efficient as an expenditure tax. So if somebody is making lots of money, is living frugally, spending very little, but putting his money into the economy, helping the economy grow, what is wrong with that? I remember when I was at university 50 years ago, we read a book that was, the author, I still remember, was a chap called Nicholas Caldo, and was promoting the expenditure tax. Tax the rich by taxing the yachts they buy, the private planes, the Rolls Royces, and the other luxury expenditure, and tax or exempt necessities of life. So I think that's probably the best method of growing the economy. But that's my opinion, and I don't think a lot of people agree with that, but I just thought I'd mention it. Now I'll hand over the microphone to Mr. Fatou Lazare to make his presentation.
Okay, thank you. I'm going to go through the 3 proposals that has been presented by the government. The 3 main ones that's going to affect most small businesses are the income splitting proposal. There are measures regarding passive investments, and then there's a third and much more complicated one regarding how you can convert a dividend that's taxed at a much higher rate into a capital gain that's taxed at a much lower rate. So we'll go in a little bit more detail into each of them, and I'll show you what the rules are right now and how people are taking advantage of it and what the proposal is, how is that going to change it. So the first one is regarding the income splitting measures. Right now, if you have a family business, you can make your family members shareholders of that company. Your kids, parents, anybody that can be a shareholder, and you can pay them a dividend. There's nothing that says that it has to be 10,000. It can be 100,000. So you can pay them any type of dividend. And if these individuals, these shareholders, have no other income, you can actually pay them close to $40,000 to $50,000 of dividends without paying any tax at all. So obviously that's an advantage that family businesses have. So as a household, you are actually paying a lot less tax compared to if you didn't have that corporation. The second advantage also is that those same shareholders, if you one day want to sell your business, they can use their capital gain exemption. That means the first $830,000 of the gain is going to be tax-free. So what you're doing also is that you're multiplying how many of these capital gain exemptions you have. It's not just the owner anymore. It's like your father, your mother, your kids. All of them can use that capital gain exemption to save tax on when you sell the business. There are currently rules regarding dividends, and really the only rule that we have right now that limits the amount of dividends that you can pay to a family member is what we call kiddie tax. That means you cannot pay a minor, so somebody lower than age 18 a dividend. If you do pay them a dividend, then they're going to be taxed at the highest rate. So the new measures, what they're proposing is that, you know what, we're going to expand that kiddie tax rule and apply to everybody who's a shareholder. So all your family members, so that means your spouse, your adult children, aunts, uncles, nieces, and nephews. And if they're not actively in the business, if they're not actively working into the business, then we're going to look at a reasonable test on the dividend. That means if you're paying a family member a dividend, let's say $50,000, they're going to say, well, is this reasonable given how much work they're doing in the company and whether they've actually invested into the company? So it's not a straight, okay, here you go and pay your tax. The second thing is regarding that capital gain exemption. Those same people who receive that dividend are shareholders, and if they're not working again actively in the company or they're not contributing to the company, when you actually sell your business, they won't be able to use their capital gains exemption to lower the tax. So you're taking two big things away from the family business. And the last thing is that before minors, when you sold a business, before minors could use their capital gain exemption in any case, but now automatically, if you're below age 18, you can never use your capital gain exemption when you sell your business. So those are really big measures that the government feels that small businesses have or family businesses have as compared to the public. And here's some of the problems that comes from it. What is reasonable? It's not a black and white issue. You're now, introducing this really gray area into the Income Tax Act that it's open to interpretation. Can a CRA auditor, sit there and say, oh, is this reasonable? Is 50,000 reasonable? Is 100,000 reasonable? How do you determine this? The rules don't really answer those questions at all. The rules also, it's so complex right now. It's that if you read it through it's like, it's 15 pages of definitions and different subsections, and it's just adding so much complexity into the act. And also, at the end of the day, you're discouraging from family businesses. You're discouraging families to actually create businesses, add into the economy with these new rules. So that's one of the big things that there's been a lot of talk of. From the feedback from the Liberal government, it's one of the ones that we know for sure is probably going to go through. It's very, I would say 90% sure that, starting in 2018 with the new budget, the income splitting aspect will be introduced into the Income Tax Act. The second measure is regarding the passive investments that Mr. Tavana was talking about. By having a corporation, one of the biggest advantages of having a corporation is that the tax that you have to pay is split into two parts. One part is when the company earns the income and you pay it 15%. And then the second tax is when you actually, as a shareholder, as an owner, you take it out and you pay the second part tax. So there's no tax savings. And I think a lot of it seems like a lot of the messaging that has come on TV and newspaper has been that, oh, corporations pay lower tax. It's not that they pay lower tax, it's that they can delay when they can pay that second tax. And that's the deferral that the government doesn't like, because they're saying, I don't want to wait until that day that you're going to take the money out and pay tax. I want my money now. And they're saying that if you're taking that profit in your business and if you're investing in, let's say, a rental property, into stocks, or just even leaving in the bank and not investing it directly into your business, then we want our money up front. And they're actually discouraging you to do that because a tax rate could go all the way up to 50%, and there's an element of double taxation going to be in there. So they're completely taking away the incentive of you leaving any money in the business and actually investing it in other ventures altogether. There's no specific rules out there. They just said that they're going to do this. There's actually no technical analysis that they've put through to actually tell you how they're going to do this. They just said that, yeah, you know what, we'll come up with a way and we'll just put it through. So I can't even tell you what the rate is exactly, but I know for sure it's going to be around that 50% mark. That's going to happen, but there's no mechanics of it. You know, how are they going to like, track, the pool for investing in the business versus the money that you're putting in passive investments? We are pretty sure that it's not going to affect what you have, the investments that you've made right now. It's going to be more on a go-forward basis. We're pretty sure it's not going to be grandfathered in, but again, we don't know exactly for sure, so I can't really say anything. Again, there's no guidance, and again, if they bring something like this into place, we can just imagine how complex, again, it's going to be, and it's just going to add complexity into the accounting of it, and it's going to fall on professionals and accountants to do really their work for the CR, because now we have to track what is passive, what is active, and all this kind of stuff. And this one is the one I would say that has been one of the biggest backlashes, from the media and from the professionals, and I think it's one of the ones that probably going to be, we're hoping is going to be delayed with more consultation, and also have more time for us to look at the details once they provide us what the details are and how they're going to actually implement it. So the third measure is this concept of, there were certain sections in the Income Tax Act that we could benefit from by lowering income taxes. And this one actually came into effect in July. The minute they introduced these proposals, they said that's actually going to be effective July 18th. So there's nothing you can do about this now. But I'm just going to let you know how it's going to affect you going forward. The first proposal was, there was a specific section in Income Tax Act, which was the 84.1, where under certain circumstances, you can actually convert a dividend that's going to be taxed at a high rate into a capital gain, which is taxed at a lower rate. So a lot of people were taking advantage of this and obviously saving tax. The problem is that this first rule, what they've introduced is so broad that it's actually accidentally catching other things into it. And one of the biggest things is that it's going to catch, again, family businesses when they're trying to transfer the ownership of their business from one generation to the other. So imagine a father or a mother who is trying to retire, they have a successful business, and they want to transfer that business now to the kids because they want to actually take that over. Well, we could actually do that in a very tax efficient way and not to tax the business so it can continue. But now, you actually, if you do this using these new rules, you can actually be double or even triple taxed if you're transferring the business from one family member to the other. If you actually sold it to an outside person, there would be no problem. But it's as if they're penalizing you for actually keeping the business in the family. So that's one thing that has been, it's really excessive. And the other one, and the second proposal again was a section that was called 246.1, was in regards to how capital dividends are treated in a corporation, the capital dividend account. And again, the proposals are so broad that, simply put, is that if you, for example, have a rental building in a company and you one day want to sell it, ordinarily you would have a capital gain. That means the maximum tax that you would pay would be 26%. But again, under these new rules, because they're so broad, it could effectively mean that, no, you know what, if you do that now, you're not going to get that 26% rate anymore. You're going to be taxed again at 50% rate. Okay? And the second thing is that, again, it's not that I'm saying it's going to happen, but I'm just saying it's so broad that they could actually apply this, but it also applies to life insurance policies, for example, in your company. If you have a corporate-owned life insurance policy, again, if you apply these measures, it could be that that life insurance policy is not going to be tax-free, which is right now it's tax-free. And what it is that the proceeds of the insurance policy goes into your company, and then it's paid out to the shareholders tax-free in order to, obviously somebody has passed away to help with the living. But now, if you apply this, it could be that the proceeds of an insurance policy would be taxed again at the highest rates, something again 50%. So again, if you had $1 million policy, which you thought it was enough to take care of your business and pay for your debts and all that, now you have to say, well, I don't have $1 million anymore. I I'm only getting $500,000. So now you have to see, well, do I need more insurance? Then you really have to redo your entire estate planning. And as I said, this is effective as of now. It's, but these all have been presented to the government, and I think they have made comments that, yes, okay, we understand what you're saying, we'll look into it, and maybe hopefully change it in a way that it doesn't catch these specific items, and to somehow, but again, we haven't really heard anything other than that so far. So those are the three proposals. Obviously, it's very, very drastic. Just to give you a little bit of history, I was talking to one of my tax partners at the office. He's older than me, and he said, Amir, these changes are so drastic. We haven't seen changes like this, that it's effectively changing the entire way that the entire corporate Canada is being taxed. The last time we had changes like this was back in the 70s. Back in 1972, he was saying that, that's when we got our modern tax act. And it actually took 10 years to make those changes. He goes, what's the rush now? Why is it that we only have 75 days for such drastic changes into the tax act? It took us 10 years last time. So why aren't we spending more time now to look at all these items that is affecting everybody that I'm sure it wasn't their intention, but unfortunately, because they're putting it through so fast, I don't think we've had a chance to think about all the ramifications of and how it's affecting the economy, and obviously family businesses, corporations. So that's the presentation. If there's any questions, we're open to questions and comments, and yeah, thank you.
I think the tax rate, and I think the passive income issue is the most important issue of all these from my perspective, as Mr. Tawana has also pointed out. They would like to tax the passive income in the corporations at roughly about 73%. So if you earn interest income in your corporation, the tax will be 73%. And there's a calculation, there's a reasoning behind that, but from Mr. Murnau's perspective, I think that would be the largest amount of tax they're going to be able to raise. Mr. Murnau also, it was in the Global Mail a couple of days ago, he referred to this money, all these monies that are in the corporations that are coming out, as dead money. Basically, I think the intention is to flush out all this investments, all the cash that's in the private corporations out, and collect the dividend tax rate on that amount. So that is the policy on it. I think it will have a significant impact on market values of many things, as if you have to have, if you have to dividend out, you have less cash to be able to buy those investments, so that for the market value on those investments, whatever they are, will go down and after.
You have to sell them as well to raise the money.
Yes.
Yeah.
So I'm very dumb about understanding about capital gain, income, blah, blah, blah. Mr. Tawana knows for 30-some years, I never understand. But just give me an example and you brief me. Supposing in one of my corporations, I gain $100,000 this year. And obviously I have to pay 15% tax on that, on the corporation, okay? And this 85,000 remain in the company for other investment that if I want to do, which I usually do. This new rule means that that money remain in my account would be taxable, or before even I take it as a dividend.
The income of that money will be taxable. So if you invest that $85,000 in active business,
Yes.
they don't have an issue with that. That means if you buy equipment to expand your existing business. But if you spend that $85,000 and invest that $85,000 by investing in a real estate project, or it'd be that has rental income, or you have it in a stock market, you put it in a stock market that you're earning dividend income, or you have capital gains, that is passive income, and that income will be taxed at the high tax rate, which is effectively 72.75%.
Sorry, for this 100, it's subject to where it comes, this $100,000 from what type of business?
Yes, it is. If it's active income, that means if that $100,000 initially that was earned,
Yes.
it was from active income, that will be a concern. So if it's you have any kind of business,
Supposing if this $100,000 is income from rent, getting the rent from a rental facility or unit that I have, then it is considered as a passive one?
there's no change on that. They're not changing that part of it. So if the source of the income is already from a passive side,
Yes.
from passive, no, there's not. What they're concerned about, because the passive investment currently is taxed roughly about 50% at the corporate level.
Investment in the rental property doesn't consider as a passive?
It is passive.
That's why I said if this $100,000 comes from a rental lease that I have, then it would be considered as a passive income.
Yes, it
And
is.
then 85% would be another taxable.
No, passive income is taxed at 50%,
Yes.
and there is a refundable portion to that. That means you get a refund, you pay 50% tax,
Yes.
and a portion of that tax that you have paid will get refunded to you once you pay dividends out of the company to the shareholders.
Until
So there is no deferral currently, any deferral of tax on passive income in a corporation
at
by
this
using a
moment-
corporation,
At this moment.
as always been. Yes.
And what about these changes?
These changes don't change that.
Doesn't change?
No. What they're concerned about is basically if you have active income, then you have more money to invest. So they're comparing that individual who has had active income through a corporation, versus somebody who's self-employed. The self-employed individual pays a higher tax, so they have a lesser amount of money to invest. So so self-employed has lesser amount of money. Let's assume they have a 5% rate of return. They have less money to invest. Their return is lower.
Okay.
So, but the corporation has more money to invest. They're saying you're making more money, and that's not fair.
Okay, how was that your estimate with this new law, it would be 72%, how we reached to that figure?
Oh, because they're based on their own calculations. There is again, they're eliminating that refundable classification on investment income in corporations for that type of income. So once that refundable portion gets eliminated, so the tax becomes effectively about 72.75%.
So I have two questions. First one, what do you mean active income?
If you have a store, you sell product inventory. If you're a physician, you're providing medical services, your income from that, dental services, consultants, IT consultants, anything that is not just driven by the way of investment, like dividends, interest, capital gain, rent, royalties.
The second is, for example, we have a company, investing company, invest in different industries. Our income comes from different industries. With this new proposal, it affects us, yeah?
Again, this is only one area that they're not very clear on, and they have not said that what they're going to do. And based on actually, it was at a seminar that I was at on Monday. The expectation is actually it might not even get implemented in 2018. It might even be beyond that time frame. But it depends on, again, the way they have talked about is it depends on where the source of the investment came from. If the source of the investment, that initial investment in the corporation was by way of a shareholder loan, so that was after-tax money that's invested in that company, they don't have the taxes will get reduced. But if the source of the investment is active income generated through active business, then the taxes will be higher. So it's very complicated, and how they wanted to measure and calculate all that information. So that adds a lot of extra, cost to keep that information. Yes.
I don't think there's an actual definition yet of what they consider passive income. I mean, we have definitions right now what passive income is, but I think under this new rules, I'm not sure whether they're planning to change that or broaden that, or what exactly they mean by investing in passive investments yet. You know, I haven't seen anything, but technically they're saying, listen, if you have active income and you want to buy a rental building, well, we're going to tax you something extra on that. You don't have that you don't have that $85,000 to invest in a rental property. You might only have 50 or even lower to invest, because they're going to say, if you're not putting the money back into your business, then we want our money up front. Okay, and then you can do whatever you want with your money after that. But if you want to invest it in your business, that's fine. So, and I think that's why a lot of, obviously a lot of businesses, they use that money a lot of times for different purposes, for creating a little pension fund for themselves, because they know that when they retire, they'll need money to live on or something. Or a lot of doctors will say, well, if I want to take some time off, I need some money to take out, so they use that as a way to save money. And I think that's some of the areas that you see, a lot of pushback from is the professionals, because they don't have the advantages of a pension fund. Or, for example, a lot of women doctors have said, well, if you want to take maternity leave, we don't get the same benefits as if you were an employee. If you have maternity leave, for example. Well, for us, if you want to take a year off to take care of our child, we're building up funds in our businesses for that day so we can then take it up. So why are we penalizing you? Why are you penalizing us for that? And I think, so these are all these little situations that people have brought up, that because the rules are so broad, that it's catching all these little things inside of it. And I don't think the intention is to do that, but I think, again, the process has become so quickly that we're trying to put these through so quickly that we're not really thinking about all these other things and these are just ordinary people. They're not the high income, they're middle class people too. I mean, a lot of the businesses in Canada that drives the economy are the middle class small businesses, the mom and pop shops, even, everybody thinks that doctors make a lot of money. Well, they're capped. They're capped at a certain rate. The provincial governments have capped them at certain different rates. That has been raised by a lot of doctors where, it was the provincial governments that encouraged them to actually incorporate and use the income splitting measures to save some taxes, because they didn't want to increase the rates for the doctors. I mean, that was one of the, bargaining chips 5 or 6 years ago, was that. So now you're saying, well, we capped you, and at the second time, well, we're also going to raise your taxes. That's why a lot of doctors are up in arms regarding these measures also.
So lots of business owners and doctors have life insurance, corporate form of life insurance, which they're paying from their corporation paying income. So do you think that based on these new rules, the proceeds of their life insurance in the future will be taxed the same way, or they're going to apply to, it's going to be retroactive or not? Have they mentioned anything?
Well, again, I read an article where an accountant brought this up, saying that if you read the rules, you could technically, I mean, depending on how CRA also applies it, because, we have a lot of times, we have the Income Tax Act, and, you put in legislation into it, but then how do you apply the legislation when it comes to the different scenarios? And obviously, different CRA auditors will look at differently. So, the comment that I brought was that depending on how you actually apply the rules, and if you look at the technical aspect of these rules regarding that whole capital dividend and the insurance proceeds, you could technically say that, yeah, insurance policies, the proceeds going into a company could be taxed under these new rules. So it really comes down to how, again, you just want to make sure that your rules are not broad enough that it can be caught. So you just want to fine-tune those rules to make sure that these certain items, as you mentioned, are not taxed, because again, there is a purpose for these insurance policies. It's a purpose to help with the family, the transition, to pay for the estate and that kind of stuff. And there's no reason why it should be taxed or
But
to
you
change.
consider it as passive income? Because it is a passive income in the long run.
Well, insurance proceeds come under a separate section, and the capital dividend. So that's the section that came into effect on July 18th, that already came into effect. So, so again, it's up it's up there. These are things that when you read it, you can say, well, yeah, they could apply to this, or they could apply to this also. So, and that's the issue.
last year, government changed lots of rules on permanent life insurance.
That's right, yeah.
But it's not retroactive, so many people, they applied for having their life insurance affected.
Yeah, exactly. So we don't know, does it mean that it's
Yeah,
going forward, does it mean it's retroactive, does it mean that it's for, if you already have insurance policies, it's okay? Or is it from the day you get the proceeds, so we don't know.
they're just collecting taxes.
You mentioned about investing in a real estate, and that would be counted as a passive investment. Now, what if you're purchasing that real estate for your own business? Does that count as an active investment into your own business?
I believe they have carved that out, that it is active as an investment for your business, yes. You know, one of the things that you should do this year is before, because all the income splitting side of issues don't come to effect until 2018, is maximize the dividends that you want to pay out in 2017. Yeah?
So how much is the estimate of the federal government by changing this regulation?
I'm sorry?
How much would come
I believe they have mentioned on the income splitting, which is, I think it's underestimated, they have mentioned about 230 to 300 million. And they have said on the passive income, it will be, as Mr. Morneau's words were, multiples of that amount, but I think they've estimated between $2 to $4 billion on the passive income taxation of the corporations.
Only the income of the government
It would be about they have estimated about 2 to 4 billion. I don't think
4 billion
billion on that. Yeah.
would be increased.
Yes. I think the fairest way, as Mr. Tavana was also mentioning, a 0.5% increase in HSD, the GST, federal GST, will translate, which is a 10% increase in the rate, effectively, because at 5% right now. That will generate about $3.3 billion. Because currently, I think 2016, the federal government collected net $33 billion of GST. So, as a fair tax, I guess if you have to call HSD or GST a fair tax, it is a fair consumption tax. And that will raise about the same amount of money, and it probably affect the higher income individuals much more than the lower income.
If they wanted to raise money, it's a very easy way to do that. The transactions in the stock market every day runs into billions of transactions. I remember in the UK there was a small stamp duty, like 1 or 2 pennies per transaction. If they just impose 2 pennies per transaction on the stock market, it'll shoot to billions. And nobody is going to feel it. The active business people are fine, small business people are fine. It's only the transactions that investors make. So there are much easier ways of raising taxable money than taxing the small business the way they've done.
So you mentioned that we can distribute dividends, but you said as much as we can now. For those shareholders who are not paying tax, it's maximum 40 to 50,000, right? So
Depends on the type of a dividend. Do you have other than eligible? And I think it's other than eligible, the maximum is about 34,000 right now. But eligible dividend will go much higher to 50,000.
okay, so if we pay more now, how much that extra dividend payouts will be taxed?
Well, it depends on the tax
So
bracket,
consider
but
less
it will be much less than next year, for sure. Up until about $200,000, yeah.
So
It depends on,
that portion will be taxable, or they gonna total the?
well, it depends on the total income of the individual, so wherever
They
it
don't
falls.
have any other income?
So yeah, anything above the 40 or 50,000 will start being taxable.
Over 40?
Yeah.
So at the end, it's a good move to distribute unpaid
Dividends.
dividend right now.
If you use the assumption that these are going to come into play, yes, which we don't know yet, but it seems that they're coming into play. So it's like a game you have to play. You have to say, well, Am I taking a risk here? Yes. I mean, we think it's going to come through. The income splitting for sure is going to go through, and it's one that I think the ordinary public, if you talk to the ordinary person, say, well, yeah, why should they get, why should these business owners get a tax-free dividend? And it's understandable, and I think it's a political move, and that will for sure go through, and we're confident that the income splitting measures will go through for sure. So yeah, I mean, I would say that, talking to your accountant, you should definitely try to maximize these dividends this year. So really, you shouldn't, up to $200,000, if you want to pay, you should just do it now and get the money out at the lower rates.
There's also on the capital gains side of it too, that the capital gains exemption that is going to be eliminated for children under 18 and adults over 18 if they're not contributing to the company. There is a one-time election that it will be available in 2018 to be made. So it's getting a little bit complicated here, but it will mean that for a company to be eligible for that capital gains exemption, they have to do certain things. They have to prepare the corporation for it to be exempt. So it might mean that those actions would have to be taken in 2017, so you're eligible to make that election in 2018. So it is, don't want to get into all the little transactional details, but.
So from the day that they started this legislation, announcing it, till the day that they probably start applying it, how long did it, 75 days? 75 days?
No, that's not true. Sorry, I have to interject. That's just a consultation period.
Oh, that's just a consultation period. So
But
when was-
it's 75 days though, to be fair, it's July 18th, summertime.
Absolutely, there's no question about that.
And
But
the
the way the
period-
question came out,
Yeah.
the way the question, and I apologize,
Yeah.
the way the question came out and the way I understood it was that from the day that it was announced to the day that's going to take effect is 75 days, and that's not a true statement. Just wanted to correct.
Oh, okay.
And that was my
It
understanding, the way I
It
understood
hasn't
the
been
question.
determined when it's going to finalize, because it's going to become like actual legislation and going through the Parliament. Yeah.
But anyway, it's less than 6 months, right? Less than 6 months.
I don't know. I
It
honestly
was
don't know.
July, I think.
Yeah, the consultation period was 75 days. That means that, different organizations, basically they're listening to everybody's views on it. So the consultation period is closing, and now what is happening is that I believe what the process will be is that obviously the government will take all these comments into account and review the legislation. I'm hoping that on the passive investments, the technical aspects of it will be introduced so people can read it and see how that's going to be taken into effect. And then they would have to go through the budget process, and when they introduce the budget, they would introduce these legislations, and then it would have to be voted on and passed, and then it would come into effect. And then the effective date, even though maybe they're voting on it, let's say in April or May or something, but the effective date could be from, let's say, January 1st though. So they can go back and say, well, the effective date of it was from the start of 2018, for example, even though it might not be voted on until later on in the year. And that's how usually the budgets do work like that. Like a lot of times March, April, the budgets are introduced, and then you have to wait for the vote and everything, and then it becomes like passed along.
Because for many less important subjects, you have at least 1 year to think and decide and discuss about it. So this is short, and it's very important. It's a big change.
I don't know whether you follow Mr. Trump's proposals. I had the impression that we in Canada are going different directions comparing what Trump yesterday said. Give me a global understanding of these two systems? Canada is going to take money from corporations, it seems. I don't know whether that means. Mr. Trump yesterday, the day before yesterday, all the time, of course, he was saying that going back to corporations, bringing back the American corporation back to the United States. Do you feel the same as I have the feeling? Is that correct?
I'm not too sure. All the U.S. taxation laws. Yes, they are reducing the corporate, they're proposing to reduce the corporate tax rates in the US, which are currently at 35%, much higher than Canada, to reduce it down to 25%, I believe. But I'm not too sure, you know, again, the corporate tax rates are not changing with these proposals. All they're doing is basically, they're saying that the structures that were in place, they're not valid anymore. How you had set up a corporation by having a shareholder with a nominal investment, maybe a $100 investment, $10 investment, that's not good enough to become a shareholder to be entitled to dividends. I don't know the corporate tax rules in the US to be able to comment on that, but I don't think they're touching on that. But one thing else that they have proposal, that Trump has, in the US they have made a proposal, is the elimination of the estate tax on death in the US. Whether, you know, obviously, I don't know if this will all go through or not, but it's a significant difference. That will make it a significant difference in terms of taxation when there's a transfer of wealth from one generation to the next in the US versus Canada.
Comparing the US tax system, especially with regards to corporations, the Canadian system, the US tax system is totally broke, while the Canadian tax system, the corporate tax system, is very efficient. Canadian corporations can invest overseas, and they can bring their money, if it's from active business, tax-free into Canada, which is not the same in the US. As you know, Apple's got billions of dollars and outside the US, and they can't bring it in because there is another tax, but not in Canada. So we have a very good tax system, and I hope they don't tweak it to become anything like the US tax system. As you said, you know, maybe we're going the other direction and they're coming towards us. But hopefully that will change for the better.
Okay, my question is, with respect to that, you called it a dead money, right, that sits in your account?
Yeah, Mr. Monroe.
Okay, well, you exactly quoted him, right, the dead money. What happens, let's say, if you just, like, I mean, you earned it, you paid your 15% tax on it, and it's just sitting in the account for the rainy day, because there are businesses that, you know, every small business, you know, has a rainy day that comes up. So how are they viewing that? Can you argue that the money that is sitting, or that amount that's sitting in your account is technically, or you're forecasting some, you know, unforeseen circumstances or something like that, or sometimes there's market trend downs and, you know, whatnot. Can you argue that without even taking it up? Like, I understand that if you put it into an investment, it becomes a passive income, right? And if you put it to a family, obviously you're closing that loophole. But what if you keep it in the corporation?
So, I mean, obviously, even if you took that money and put it in the bank, you're probably getting 1% interest, right, or 0.5% interest. So technically, that comes under the rule that it's a passive investment because it's earning interest. I think to a certain degree, you can argue that every business needs working capital and to a certain degree, amount of cash reserves. But if it starts growing and you're just saying, I just want to keep it for a rainy day, I believe it's going to come under these new rules. Because no matter what it is, it's still earning even that small amount of interest, it's still passive, and you caught, I believe. Again, as I said, on the second rule here, good and passive, we don't have all the technical aspects, we don't have the exact definitions of whether that's going to be considered passive, but I would assume that that would fall under these new rules and we would have to pay that extra tax on it. But again, there would be a portion where you can definitely argue that, yeah, you know, my business goes through cycles, and I need X amount of dollars, let's say, in the third quarter versus the second quarter. That, you know, and we have that right now. I mean, that's not a problem. So, so you can argue that.
So there hasn't been any changes really with respect to that if you keep the money in the corporation or potential investments within the corporation, or?
I think most of it will fall under these new rules, though. You know, if
there's not, there's, as you said, there's so much ambiguity, right, that exists.
Yeah, and that's, yes, exactly. there is ambiguity, and we want to see it. And that's, I think, that most professionals, they want to see the technical. This is the one proposal that they're saying that we will work towards the rules. So there's just been talk about, you know what, they're just saying that, listen, if you're investing in passive investment, we just want our money up front. So if you just take those comments and the way they're thinking and what their objective, I guess, is, then people are making assumptions. And yours would be, yeah, you know, if you're saving money, I mean, technically what you're doing, you're saving money in the business. And that reserve fund is growing and growing. Well, you have to make a decision on how much of that reserve fund does the business really need and how much of it's really excess. I believe that excess amount will be taxed with these new proposals.
Income on the excess.
Thank you.
Income
Okay,
or income?
No, the whole excess. The whole excess.
Oh, the whole excess too?
The whole excess will be taxed. If it's in a passive investment, there's going to be a system like the RDTOH system. If you keep the money in the corporation and you put it into active business, that amount is going to be taxed. That is my understanding.
Is it okay if I interject?
Sure.
I mean, with all due respect to the panel, I think that the examples are being used. If you could break it down. Is it okay if I go on, Francis? Thank you. Let me thank the panel because one of the things that I've noticed, they've been very factual. And over a number of times, they've made sure to emphasize that this is a draft legislation. And the second thing is, there are room for interpretation. And they're explaining different scenarios if this happens. So a lot of words that I heard is if, then this will happen. And based on everything they've said, to a large extent, I would say 99%, are factual. But we're running down a path around passive investment definition. As there is no legislation for the passive investment, it leaves a lot of room for interpretation. So I want to do a scenario that we've used a number of times actually in the House, trying to understand what the passive investment is. So the definition to the passive investment is completely still open to interpretation. So there's an example was used that the income, the net income, the key word is the net income of the corporation is now $100,000. What does it mean? It could mean that you have earned $250,000. The income of the organization is corporation is $250,000. You've paid yourself $100,000. As the $100,000, your salary is now gets a certain percentage taxes, and that's not going to change, right? Right. And then there's another $50,000 that you pay for the expenses, for the office rent, etc., etc. That's not going to get changed, correct? Now, the net income that at the end of the year is left in the company, and most of you have small company, is about $100,000. That net income is going to get taxed at the maximum rate, depending on, I mean, we have 14.4%, but let's say for just simple calculation, it's going to get taxed at 15%. So you're going to pay $15,000 to the government of Canada. Now you have $85,000 sitting in your, retained earnings. So far, so good. So on the return earning, and let's say you are now thinking about, okay, I'm trying to expand my office. I want to buy a building, or I want to buy new equipment, etc., etc. But I don't have the money. I got to put the money in an account. Well, let's not even talk about rainy days and ups and downs. Now, this is truly you're saying I'm going to save I'm going to put $85,000, and you're risk adverse like me. You're going to take $85,000, and the safest thing that you could put it would be what? Put it on a GIC. Okay? And let's say GIC gives you 1% interest. Okay? So what would be the interest on the $85,000, which is called interest on income? So what is the interest on $85,000 at 1% at the end of the year? $850. That becomes your earning on the money that was there. That $850,000, that $850 used to get, that $850, don't confuse the $85,000, that $850 used to get split. You used to pay 50% tax on that, which would be $425. So far, so right? Okay, now, that $425 went to the government, but it sat in a special account. The other $425 went stay back into the business. Now, what is the total amount of money that you have in the business? It's $85,000 plus $425, correct? Now, that's going to accumulate, and let's say you're not going to, let's say next year you're going to make another $100,000 net. So you pay 15% tax, another $85,000 comes. So you have $85,000 plus $85,000 plus another $425. And it's going to sit down. Now, the key thing is that money that was sitting in the government account, in a hold account, when you try to expand your business, or when you try to turn it into dividends, or when you try to, you could potentially go get that money brought back. Is that correct so far? So what the loophole that's being, well, loophole is the wrong word and I keep using it, my apologies. The tax proposal that right now, one could interpret, because we don't have the wording, that $425, when you went to expand your office, when you buy to more equipment, when you buy to do more stuff, that $425 would have come back and you could have used it.
I'm sorry, I have to disagree with that. The $425, only portion of it is refundable. And so roughly, let's take it 50%, 20% is non-refundable, 30% is refundable. But it only gets refunded if you pay a taxable dividend out to the shareholder, not by reinvesting in the company. That doesn't get refunded at all by reinvestment. No, the refund only comes back to you when it's actually you pay taxable dividends to the shareholder.
Okay, so thank you for clarification. The key thing is everybody thinks that $85,000 plus the $425 plus the new $85, now it's going to all get taxed at 50%. And I don't think that's the case.
It is actually. So the 85.
Can you just say?
Sure. So I'll sit down because.
So the proposal is that if let's talk about that $85,000 that after tax money. So based on the proposal right now, it depends what you do with that $85,000. So yes, if you take that $85,000 and reinvest it into your business, like you have to buy computers, you got to hire more people, no problem, no issues there. If you take that $85,000 and I want to buy Apple stock, I won't have $85,000 to buy Apple stock. I would actually have to pay on that $85,000 an additional tax first, and then whatever is left over, I can go and buy Apple stock. So that $85,000, if that after-tax money is invested in a passive income, there will be an additional tax that you have to pay. Because again, right now you have a deferral, as you've indicated. You've only paid 15% tax. A regular person has probably paid, let's say, 50% tax. You're looking at a 35% deferral, right? So the objective of the second proposal is to take away the deferral. And the objective is that if an ordinary person had a job, they would get their money, they would pay their, let's say, 50% tax, whatever the tax rate, and they can invest in whatever they want. They want to equalize that with a business owner. So that means a business owner who has a deferral of the 35% is that you shouldn't have that benefit. You shouldn't have more money to invest in a passive investment. So on that $85,000, there will be a system in place, like what you just described regarding, well, they're saying that there's going to be a system. We don't even know that this refundable, which is actually very confusing to begin with. So that $85,000 will be unfortunately taxed. You won't have all of it to invest in a rental property, for example, or in as I say, stocks or whatever. And then even if you leave it in the bank, as you said, and for that rainy day, well, how many years is considered that you can leave it behind for a rainy day? You know, can you leave it forever? Can you leave it for a year? As you said, for maybe, you don't know, maybe you lost it. Maybe you know you're going to lose a client. That means you gotta start building up cash or something. So, unfortunately, there is going to be a tax, and that's why people are concerned. Because again, look at a professional like a doctor. As I said, you know, a lot of doctors that I know are keeping some money in their businesses because they're building up a fund for their pension. Because they know they didn't want to retire, let's say, when they're 65 or whatever. So they're building up they have their RSPs, but they say, that's not enough. I want to build up a private pension for myself. And yes, it is an advantage that they're having. They're multiplying this extra money that they have in their business to grow this pension fund that they have. right? And that's fine. It is a benefit. I mean, there's no denying that. So they're, they're paying 15% tax. They're building up their investments. They're paying up pension. But then when they retire, when they take the money out that they built up, they will pay tax. They'll pay tax at whatever the rate the tax is at that time. It might be lower. Yes, it's a benefit. That, as an entrepreneur, as a business owner, you're taking also a lot more risks also. You're adding to the economy. You're creating jobs. My firm, we have 50 people. I've created 50 jobs for the economy that I'm responsible for. So there has to be certain benefits that you get as a business owner for taking risks. A lot of businesses, when they start up, they have to take on loans. Good luck getting a loan from a bank on a startup without putting a personal guarantee. Maybe you have to put up your house. People take mortgages. There are risks that business owners take. And so if you want to compare a business owner to a regular person, well, you can't do that. It's not apples and apples. Because that individual who's employed by the government or by the businesses don't have to take any of those risks. They don't have to, they're not adding to the economy, So there should be a benefit. There should be a little bit of benefit to taking on those risks, to adding to the economy. And the passive investment thing is not, well, that's a matter of, I guess, people's perspective. We're not eliminating tax. We're just delaying. We're still paying our share of taxes. Yes, income splitting, yes, I understand that. I can totally see why you want to take that away. You are technically reducing taxes significantly. I understand that, and that's fine. But the passive investments, it's not that we're reducing taxes. We're just delaying it to a certain time. And most people are using that just for their own sake. To be able to live in retirement.
I have actually two more questions now. One is, you talked about the capital gain on the conveyance of the business title to a family member. Okay? So to prevent that, can we move the business into a family trust now?
No, because that came into effect July, so you can't do anything about that right now. So that has been brought up to the government, and the government has indicated that they are looking into that. I think one of the big things that you saw in the news was a lot of farmers. Farming industry is a very, very family type of business, and it gets passed on from generation to generation. And that was one of the things that was brought up, that they said, listen, these rules are so broad that you're not that it was on purpose, that it could fall into, and I think they've been open to that, to listen to these concerns and to kind of maybe fine-tune it to make sure that doesn't happen. I don't think the intention was ever to kind of penalize a family business to transfer, from a generation to generation. I think they're open to listen to that and to make sure that they fix and fine-tune that.
And then my second question was, when you talked about the investment into a passive income, and the fact that you're taxing that up front, how would they know what revenue are you going to generate in the future from that passive income?
Yeah, we don't know that, and exactly, and that's one of the complexities
there's always management fees and other expenses that are applied.
So, and that's, once the technical aspects of things come, and once we understand how it's going to work, how they're going to track it and all that, I think there'll be more comments, and I think that's one of the reasons, as you indicated, that part of it, we're hoping that it'll be delayed so we can have time to look at those aspects of it and to make sure that, okay, let's look at the technical, let's look at rates, let's make sure that it's not affecting other things, by mistake. And so hopefully that part will be a little bit delayed until we see those things. But so I can't answer all those, yes.
A lot of anxiety at the end of the day, right?
Yes.
For especially small business owners, that they have to put up so much. It's just unfair.
Yeah.
Follow up to that question. So if you have a routine earning in a company that you were debating whether to invest, like as capital, like stock and stuff, or just take it out, I just want to hear from the panel. It sounds like you don't just take it out now.
Not necessarily, because they haven't really indicated. All the talk has been that it's not going to be a grandfathered thing. It's going to be more of a go-forward basis. So if you already have retained earnings, as you've indicated, that you have funds in the business, I think that will be okay.
But the nature of the business was going to be investment.
Doesn't matter. So whatever you've done before, like if you have 200,000 already in your business and you want to make an investment, I mean that's going to be fine. I don't think there's going to be this additional tax. Everything that we've seen, it seems to indicate that it's going to be on any going forward. Any income that you have on a go forward basis, you might have this additional tax. So if you already have the funds in your business already and you've paid your 15% tax or 26% tax, you should be okay. But we'll have to wait to the actual legislation to kind of confirm that also.
Is there, do you have, you gentlemen have any vlog or like something you cover in your website that probably you summarize all this for somebody like me who doesn't just know all those?
We have, yeah, on our website we do have a little like announcement regarding these 3 rules. So you know, if you give me your card, I can send it to you. I mean, obviously there's been a lot of articles on it. We will update it. We will definitely update it as we get more technical aspect of things, and as we hear more news from the government and the process, we will be updating the news and all that. We also have, if you give me your card, we have a newsletter. So if you want, it'll probably definitely be something in our newsletter that we'll send out. Obviously, there's a lot of news on it. It looks like there's daily basis. There's articles about it on both sides, and yeah, we'll see how it goes.
There are lots of news in Globe.
Exactly. The Globe has really covered it extensively.
Yeah,
Yeah.
every day you have something, but I'm sure that you summarize everything that to feed us.
We will,
Right.
definitely.
Do you think that this new rule will help affect small business and employ more people to spend some of the money on paying salaries or something? You're losing I was just wondering,
I think everybody's been saying this has a contrary effect because you're taking money out of businesses. I would think it has a contrary effect.
I think a business owner, you know, you get used to a certain lifestyle and a certain earnings level, right? So if you say that, you know what, I need to earn after tax $100,000 every year, you're going to take certain actions to always try to maintain that $100,000, right? So if it means that you have to pay extra tax somewhere, then obviously you're going to say, well, you know what, if I have to be paying this extra tax, that means I have to earn more money to get to that $100,000 level. So it could be that maybe you're not growing the business, because again, at the end of the day, as a business owner, I'm not willing to make less than $100,000. So you're going to take certain actions in your business to be able to maintain that level. I mean, that could be one way of looking at it. The same as me, like, I have a family, kids, whatever. I need a certain amount of money to live on, and I'm not willing to go below that level. Therefore, we as a group, as a business, as a partner, we're 6 people, we're 6 partners. We'll take action accordingly to maintain that, unfortunately. And it's my selfish? Well, yeah, at the end of the day, it's a business that we've put a lot of sweat and work into it, so to reap those benefits. So if it means that I have to let somebody go to still maintain that, I'm not saying we are, but these are decisions that businesses will have to make, as you said. But at the same time, it could be that, maybe they are saying that, well, okay, well, if I have to pay this extra tax to put an investment, it could have the other effect also. I have to be fair, that business might say, well, maybe I'll do that expansion now versus maybe 2 years from now, which I had it planned. Maybe I'll go for it right now as opposed to later. So it might have that effect also. You have to be fair. Some owners might think like that. Say, yeah, you know what? Let's do that now. Let's go for that market that we thought that would, maybe. So you can go both ways.
But not all businesses are expandable.
Yeah.
Exactly. No, for sure.
There's limitations on every individual in terms of what their ability to do, and also limitations on the business itself. Like if you say, let's take a professional practices program, just saying from the county board, but the medical dental, there's a limitation in terms of what the size can be.
As I mentioned at the beginning, the purpose of this gathering is just to convey our message through MPs Mr. Johari and Mr. Sasi and I think the ladies when they got all of them office from the down by the west. Therefore, we can echo our result of our talk to Otto, to 3 Channel. I'm sure that they will take whatever we are saying, not to support me, but the party is influencing to tell us to accept. You as a chief professional who have each one of the many years of experience and have a lot of clients like me and maybe other small and big companies or individuals. As a professional, considering that, okay, the government may need this money, okay, which, as Mr. Tawana said, one of the options is just 2 penny of the gambling in the stock market, the big casinos, would be very fair to implement, maybe easier, and don't go with so many regulation and make CRA more busy, or what Mr. Parya offered into 0.5% GST, which for sure, because of the voting number may affect them, for sure they will hesitate to do that, but would be easier because anyway, those who are having more income or those who are participating in HST and GST, the person who makes $50,000 for sure, the buying power is 1/4 of 2%, which makes it $200,000. Therefore, those who are richer, they pay more participation of that. But anyway, what could be your proposal? I mean, your experience, the info you are having from your client and your background to convey to this gentleman and a lady to transfer to Otto?
I have to remind everyone that, let's say eligible dividend. Okay, if you receive a dividend, eligible dividend used to be taxed at about 25% about 5 years ago. At the highest tax rate. This year, in 2017, the highest tax rate on uneligible dividend is approximately 40%. So it's not that the taxes have increased at the provincial level by the Liberal government in the province. And the very first legislation that was passed through by the Trudeau government was basically to increase the taxes and the high tax rates. And they always talk about fairness between high taxpayers and low taxpayers. There's a big inequality, I think, in the low taxpayers. Do you know how many old age security supplement recipients are there who are receiving old age security of $20,000, $25,000 a year? That they should not qualify for that, and they are considered lower income individuals by the Liberal government, and it's not fair. It's not fair for the high tax individual to pay that income to that lower tax individual, and they're collecting all this security. Or the current child tax benefit, which is $6,000 for children below 6 years old, and $4,000 when. And it's only income based. At the same time, at the provincial level, tuitions for families of less than $50,000 of income are paid for, are free, and no consideration by how's that income verified? How is that income justified to give those benefits to a lower income, and it's all subsidized by the higher income? So the fairness is not there because all the programs that are available on the lower income side, people are cheating on. So that's where the inequality is. That's where it is not fair to say this is to make it fair. It's not.
So would you say if they were not cheating, and the cheating could be
But
stopped,
it's very difficult. You try to.
Sorry,
thank you. On the old age security side, it is very difficult to assess.
So would you say if the cheating could be identified and it could be stopped, then the concept of what's being done is a fair?
No, that's not what I said.
No, I asked you whether you're saying, okay.
No.
So you're saying regardless, that's not a fair system?
No, I think the issue is, and the real issue is to raise funds to fund the programs that are in place. I think that is the primary issue. When Mr. Morneau refers to this money as debt money, and he basically wants to flush out all the cash out of the corporations, it's basically to generate revenue for the government to fund programs.
That could be one interpretation. That could be one interpretation.
But that's what he said, and that was Mr. The governor from Bank of Canada. So,
I think Mr. Fatullah had presented a balanced point of view, not that you have not, but what was said, the purpose of the corporation was number one, to protect the, separate the asset of the incorporator from the business. That's number one. Number two is the retained earning is intended to be able to help the business grow.
When was that stated?
Well, that was one of the
No,
statements that Mr.
I know, but it was
Fatullah
never stated in any time that the corporations the funds that are left in the corporations are only intended.
No, I never said only.
I know, but that has been the presentation, that's been what Mr. Morneau has presented now, that was the intention behind it.
When a corporation enjoys a lower tax of 15%, as you
Yes.
said in US, at 35%. The reason that the taxes were lower than the small businesses was to provide an opportunity for helping the economy to grow.
Yes.
Not necessarily to shelter tax from being paid or revenue being paid or money. I understand that the businesses need some money to be able to invest, make the business grow, put some money aside from, rainy days and invest in pension, etc., due to the risk that they're taking, due to the fact that they don't have a pension, due to the fact that they don't have an EI, due to the fact that when they take a maternity leave, they're not getting paid, due to the fact that they're taking a responsibility and they're taking a risk putting their mortgage online to make sure that they're in payment. We get all of that. And that's why the interest, the income tax on small businesses is 15%, and it was part of the platform to actually go from 11% to 9%, which we've gone from 11 to 10.5.
Yeah.
There are some large corporations, which again, Mr. Fatullah is very nicely articulate that you're casting the net too wide, unintended. And the interpretation is there are a lot of small fish getting caught in that net that should not be in that. That message has been clearly given to the government, and the government understands. Now they're trying to understand all the scenarios. So one of the things that was very most powerful about your presentation was the fact that you gave a both balanced approach on both sides, and you said, hey, look, this is an unintended consequence. This is or could be. So bottom line is, if that money that's coming into the business, you're saving it for your growth, whether it's saving it for a period of time to be able to accumulate it, to be able to use growth, we don't believe it's going to get impacted. And as small businesses, you're not going to be impacted. These are for businesses, large corporation, and it's about 20, and the numbers will come out shortly. It's about 30,000 large business across Canada of the 1.7 million. That's going to get impacted, because they're using, they're using various methods to be able to transfer. And on passive investment, you're 100% right. The language is very ambiguous. There leaves room for a lot of interpretation, and impact of it might be that it could be taxed up to 72%, but I don't think that's the intent.
Do you agree, Mr. Johari, that public corporations pay tax at 26.5% on their business income? And all these rules only apply to Canadian-controlled private corporations. They do not apply to public corporations. Public corporations can accumulate funds invested in passive assets and will not be penalized. Is that fair?
So right now, I mean, we have to look at the number of public corporations and how the public corporations are run and what kind of auditors is done and what taxes. And you guys are a lot more qualified than I am on that one. I just, as a former CMA, I understand some of the tax implication. I don't understand completely. So whether it's fair or not, it's very hard for me to be able to say that, because I'm not at the same level as you are being able to debate that. And that hasn't been the part of the legislation that we're working on, so I'm not educated on that piece as well. But on the legislation for private corporation, not all of them are subject to the same restriction that I would say a public corporation needs to go to get their income, annual income verified, because their shares being publicly traded, and it needs certain level of security. And probably either of the other two panelists could comment on the fact that does a public corporation go through the same level of scrutiny, does a private corporation go through the same level of scrutiny from many aspects than a public goes?
Yeah, you're absolutely right. But what doesn't stop the public corporation to invest in passive assets? It can invest in passive assets, and under the proposed changes, those monies that go into passive assets are not taxed the way they would be taxed in a private corporation. They would continue to pay tax at 26.5% on their active and passive investment income, and the private corporations, if they have any investments in passive assets, the taxes like Mr. Harris.
So the message that's come very clear is that the definition around passive investment, the word passive investment, leaves a lot of room for interpretation.
Well, the Income Tax Act does not define passive investment, but it defines active.
Company over 3 or 4 years to be able to buy that equipment or expand the office, etc., needs to be treated, and I believe it will be treated separately.
I think our tax system is very, very sophisticated. I think over the last 30 years, I think it has been updated, and we do have a very nicely integrated system where the tax act has been always designed that no matter if you have a corporation or if you're an individual, at the end of the day, the intention has always been that you're always going to pay the same amount of tax. Notwithstanding the income splitting, I think the integration that we have in the system is that yes, you get a deferral, but it doesn't mean that you're not going to pay that tax. And it took all these years, 30 years, to come up with this tax act and to make these changes. I feel that and if you talk to a lot of tax professionals and accountants, these changes are so fundamentally different that it really changes the entire way the tax system is working. And to do it in such a short period of time, where the first version of it took us so many years to do, I personally don't understand what the rush is. I understand there's changes to be made, but what is the rush to do it in such a short period of time when it took us 30 years to get to where we are right now? And then suddenly to fundamentally change the entire tax system of how corporations are taxed, how these passive investments are taxed. I feel that you're doing it in such a short period of time that we are not have enough time to look at all these effects that it has on these other things that it wasn't the intention of. And if you can just slow down the process a little bit and study these things. And I mean, I'm not sure the mandate's coming that we got to get this done right away, or that we have this fair system. I mean, there's a lot of things that are not fair. I mean, that's life. But again, at the same time, our system, our corporate tax system, has created an economy for us that's one of the best in the G8 nation. I mean, our growth, it's because of the tax system, because of our rates. We have so much inbound traffic from different countries. It's because of our tax system. So why are we now trying to change that and to risk the economy? And I think if you talk to everybody, it's the small businesses in this country that create the most amount of jobs to the economy, they add to the jobs. And now you're just adding a complexity to it, and you're adding this other burden that could take away what is the motivation now to grow now? You're adding all these levels of taxes onto these individuals that, what is the motivation to grow the business? What is the motivation to expand your company, to make more money, and to create jobs for people? It seems that motivation every day is little by little, these little things is taking that away a little bit.
So actually the motivation is exactly what you just said, to invest back into the company and to help the company grow and to create more
but
jobs.
It's not, though, as I said, it's not.
But sometimes if the growth is not done in a timely manner, it could actually damage the business. If the growth is not done in a timely manner.
This is exactly what I'm saying. The definition of a passive investment over a period of time is something that's being considered. So if you are saving $85,000 a year to be able to accumulate enough money, or close to, let's say $300,000, $400,000, $500,000, and I'm making those numbers up, so you can go buy that office or you can qualify to get a loan from there. that's not considered, or that will not be considered as a passive investment. But again, that will
From
give-
my experience with my professionals that we have, that money that we call passive, it is being invested. Okay, it is invested. It is already invested in real estate. It's invested in the stock market.
Those are creating jobs.
Those are creating jobs. So why is it? Yeah, but why? But under this proposal, you're going to be taxing that. There's going to be less money for that.
No, a passive investment, there is no even legislation, there is no proposal, we are just listening. So the fact that you're saying,
The proposal is that if you're going to invest money in a passive investment,
yes.
you will be taxed an additional amount. That means that person who, under this example, had $85,000 to go buy a condo that he wants to rent out, won't have $85,000, okay, to do that. He might have maybe $40,000 or whatever number it's going to be. There's going to be less money for him to have to make that investment, right? And under this proposal, I mean, that's what the proposal is. He's going to have less money to invest back into, not his own business, but most of my clients don't have money just sitting there. They're investing it back in the real estate business here in Ontario, in the stock market, which in itself creates, goes back into the business. So they are investing back into the business. It's not just dead money sitting there. And at the same time, one of the greatest mandates of the Liberal government and why the CPP rates are going up was because the government felt that we can't save money for ourselves. So so now you have these professionals who are trying to save money, but then now you got to tax them. I mean,
that could be one way that's interpreted. But again, going back and on the passive income, we've clearly heard that the money that you're keeping in the corporation to be able to get to a level that you want to be able to expand should not be considered as a passive investment. If you are making an investment, and this is what we've heard, and this is what we're communicating, that an investment is an investment so long as in any way or shape is helping a growth anywhere in the economy. If you are a doctor, and we pick doctors because especially the doctors, aside from the office and hiring other doctors, etc., at a certain level you can't expand anymore. Someone like the emergency doctor will never have an office. So long as that investment is going to go into buying properties or diversifying your risk portfolio of the money that's sitting in the corporation, it's not going to get impacted. That's not the intent.
So what is going to be, you can say that to any type of investment because any investment is going to grow the economy. So what is it they're going to tax them?
So if you keep that money in the business and do not use it and accumulate it to a point that you're going to take it under the strip surplusing model or under earning limit, etc., that's what they're going after.
That's not clearly what has been communicated in any of the...
Let's agree on a couple of things. Number one, the timing and the length of time. Leave some questions and we take that granted. The other thing is, could the communication on this thing was better? Absolutely. So let's acknowledge those two from my point of view. Majid Johari, Member of Parliament from Richmond Hill. And I'm not talking on behalf of the government here. I'm talking about as an MP who has heard from over 300 members in his community. I acknowledge that the communication and the timing could have been different, and me being able to have the depth of the knowledge as an average MP, it could have been better. So I want to acknowledge that.
I made a positive point because liberals are under attack, it seems.
Yes.
I support the idea of if the central point is between active investment and passive investment, I think there is a wisdom.
Sorry, it's a what?
There is a wisdom in this plan, changing from passive capital gains to active. This is the situation in Canada. More and more money goes out of the active industry, active business. I think this is a positive point in this plan, and we have to think not only for our individual narrow interests, thinking of the whole Canada, the whole situation, That is a tax in the final analysis is a political orientation of a political party. I think I give a point to that as part of it.
Again, let me go back to reiterate, and I keep interjecting, I should be listening more than I'm talking. But I just want to acknowledge the fact that what we saw today from the panelists was a very fair, balanced, and accurate articulation of the concern if asked, these proposals could be interpreted in different ways. And I saw both sides of them. I saw the side that they will focus on growth. I saw the side that it could be interpreted that way. And they were very, very qualified statements. And for that, I thank you very much. And I want to assure you that what you have clearly articulated to this group has been accumulated, and it's going to Ottawa. So thank you very much.
There's a question on that.
First of all, I want to thank you guys. You guys are terrific. You did do a great job presenting some of the facts. Sorry? Okay. Well, no, I just wanted to, if the intent of this was to convey our concerns, or perhaps to the MPs, I'll just add this to it. By our own admission, and maybe you guys know the updated facts, small to mid-sized businesses account for about 70 to 76% of the economy, of the Canadian economy. And we have, I think this is just, the concern is this is just another way of putting shackles again on smaller businesses, where we don't have, like I'm speaking as a small business owner here, I don't have the resources as even, and I go as far as saying public companies, why should they be exempt? And on many times, as private business owners, we're in direct competition with the public. I hire an employee for $18 an hour. I've heard stories from people, and people are nodding. My employee gets hired directly by a public company for $32 an hour, doing the exact same job. Many people will attest to this. So we are always directly competing. Why should they get that advantage over us and be exempt? Is, I think, the concern that a lot of people are going to have. The public, for example, when they can invest, some of the public companies are being exempt, for example, right? I think the concerns is to limit and to make it an even, if there is going to be a bias from a government, whether it's provincial or federal or whatnot, I think the bias should be toward the smaller businesses and give the advantages to the smaller businesses as much as possible, and not.
The small businesses already got a lower tax than the public.
So right now, what the intent revenue, when they said it's going to be about something like $3 billion, for example, that you mentioned, that this will bring in about $3 billion. Yes. Is that figure based on the current climate of businesses? When this has some negative impact to businesses, will that number perhaps fluctuate? Will the government actually has that been gone to account? So we don't know that. Sorry, I just wanted to just ask that.
I don't know. Again, they have never been specific in terms of what the impact on the passive income taxation will be, but it was just, I think it was on Thursday, Mr. Morneau referred to it, that will be multiples, that tax effect of it would be multiples of the income splitting line, and they have estimated that to be between 250 to 300 million. So, I mean, again, I've just heard of between $2 to $4 billion. So one thing I just, again, in terms of communication from the local government, they have referred to all of these structures as loopholes. There are no loopholes. These are all intended structures that were designed, encouraged by everyone to use. So it's just very clear to have my 18-year-old as a shareholder by him buying shares of a company for $100 that he got as a gift from his grandpa. It is legitimate for him to be shareholder. It is legitimate for him to receive a dividend. That was the structure that was designed, and it's been in place, and that it was not a loophole.
So let's acknowledge some of the wording could have been a lot more focused. The word loopholes was how some of the large corporation used some of the existing structures, such as holding companies and such as the trust funds, to be able to do, surplus stripping. So the wording should have been a lot more focused rather than, again, casting that net. So we all, for those who understand surplus stripping and how you create holding companies and how you create trust funds and how you do through arm's length transaction and pipeline, you actually sell shares that doesn't exist to another company, and then you get a note and you bring it back and you convert your income into capital gain, and all of a sudden you pay $830,000 to a two-month-old child that was just born because they paid $100. Everyone agrees, once they understand it, that's truly is a loophole. It doesn't mean that it's illegal. It means that we've got a lot of creative, and I gotta be careful how you use it. We have a lot of creative advisors that use the existing structure in a very creative manner to be able to convert either earnings or capital gain, earnings or income into not income earnings into a capital gain and avoid paying taxes. This is where the focus is.
That's the, Mr. Johari, that's the pipeline.
Yes.
And that is quite, you're close to say it's a loophole. But the pipeline is normally used upon the death of an individual.
And that's being addressed.
Yeah.
You're 100% right. We heard about the farmers, we heard about the fact that, and I'll give you a very example. I have a lot of friends that are in the health profession. And they've created a corporation, they've invested, the whole family has invested in this, and the kids now are going to school to join that profession because their parents are already setting up the base for it, okay? The intention is not to get after those guys because they're already expanding. If you have two kids and you're trying to set up two different practices, you're already growing the economy, you're already contributing, you're already buying a new office, you're already buying a new equipment. The government is not intended in any ways to go after those guys. These are the guys who are trying to, at the end stage, trying to convert the return earning to pay 36% to, all of a sudden paying 0%, qualifying for people under $830,000 capital gain and pay 0. And some of that is a creative use of existing laws. This is what the government is going after. And unfortunately, as you all said, the net has been that it's understood or perceived or poor communication has caused everyone to think the net is going to be cast so wide that's going to grab a lot of people. The 73% of the people that are affected. That's not the case. The numbers that's going to come out, you're going to see that's going to be different.
Any idea on the timing?
If I knew that, I'll be buying a lottery ticket right now.
If I could just add to what Majid was saying, first of all, I really want to congratulate Parya. This is a blue collar, a blue chip. Sorry, I didn't mean to say blue collar, blue chip panel, and it's amazing to see.
They're all wearing blue.
It's amazing to see this panel here. Thank you very, very much. I think that the main thing to bear in mind is you're absolutely right. The government did not communicate this well. Not only did it not communicate it well, if I were a business person, I'd be up in arms about some of the wording that was used. I think we can all agree that the government even concedes that they did a very, very lousy job on that. Majid also said that even before he highlighted that reality. So that's the first thing. The second thing is this stuff is so incredibly complicated. As you would know better than the rest of us. But the government is truly, truly shocked by the reception it's received from various people. And their biggest concern right now is to deal with those unintended consequences, to make sure that they taper it, to make sure that they come up with an approach that's reasonable. I can tell you of all the issues I've heard regarding since the first day I was elected, if you take every single issue, put it on one side of the scale, I have heard more on this issue than all of everything else I've heard. It is incredible, and I can also tell you that even when when we have, small meetings with the minister or even a national caucus, a lot of MPs have huge misgivings about various aspects of this. So that message has made it through. The minister is fully aware of this, and he is trying to come up with definitions and tests and thresholds and things of that nature to make sure that those unintended consequences are there. So as to what the content of that will be, much like Majid, I have no idea, but I know that that message has gone through and everyone's very much concerned.
Thank you, sir. Thank you.